Okay, good afternoon, everybody. This is Chuck Hughes. It's great to be here today. We have set up a series of webinars on a regular basis so that I can discuss the current market conditions and strategies with all members. So this is a great opportunity for the members to ask me questions about the strategies and our current portfolios, and this is a great venue for me to help you implement the Inner Circle trade recommendations. And in the last webinar, we discussed getting started with Inner Circle and how to make best use of the Inner Circle advisory service. So if you have not seen that webinar, I recommend that you view it. It's available in the member section of Inner Circle Advisory site. So, going forward, the webinars, in case you can't attend, will be available. We're going to record all the webinars so that you can refer to them if you have a question about a strategy. So today we're going to discuss profiting in volatile markets, and which I think is very appropriate. Over the last several years, we've had very volatile markets, and there's been quite a few periods where there's a lot of price swings and market volatility, but no real change in the S&P index. And I'm going to show you a couple of slides here. These are different time periods for the S&P, and as you can see, there's quite a few price swings, and but the S&P winds up just about unchanged over this period. So the challenge is to profit in this type of market. If you took long or short trades over this period, you could easily get whipsawed by these price swings. And then, as I said, the S&P wound up just about unchanged over this period. And so the challenge is to use strategies that work in these types of volatile markets. Here's a snapshot of a recent, actually this is last summer of 2010, and you can see again we had the wide price swings that summer, and the S&P wound up just about unchanged over this time period. And here's another snapshot. This is more recent, and again wide price swings with very little trend and very little change in the overall price of the index. So what we do during these periods of market volatility is we use the volatility strategies, and that would include the married put strategy, where you purchase stock and then purchase a put option. And normally you purchase 100 shares of stock for each put option. Then there's the covered call strategy, where we sell call options against our stock positions. And then option spreads, we sell call options against our option positions. And we also trade in the money option spreads, and that's a great strategy also for volatile markets because you have lots of downside protection. The stock can take a lot of wide price swings, and you won't get stopped out of your position. And then another volatility strategy would be to sell weekly option premium to generate cash income, and those would be weekly options. And The overall goal of the volatility strategies is to increase the profit potential of a directional stock or option trade. So if we have a stock position or an option position, and the stock or option moves up in price, and then we sell a call option at a later date, we can dramatically increase the profit potential of our existing position. And for those of you that have been members for several months or several years, you'll notice that in order to protect our profits, if we have a profit in a stock or an option in the stock portfolio or the option portfolio, I normally will go ahead at a later date and sell a call option against that position. So when you do that, it increases the profit potential of the stock or option trade. And it also provides downside protection for the stock or option trade, because the short call will profit as the stock moves down in price. So if we have a stock or we have an option and we sell a call option, that provides downside protection. In the event the stock declines in price, the underlying stock or ETF, the short call will provide downside protection because it profits as the stock moves down in price. Also, if we purchase stock and buy a put option, the put option profits as the stock moves lower in price. So as you can see, we're changing our directional trades into not quite pure market neutral, but as you'll see in our portfolios, the way we trade these sell call options or buy put options, it provides a lot of downside protection. And so that's what you have to do in these kind of volatile markets. By doing this, it helps you maintain the position during volatile markets and wide price swings and avoid being stopped out of your position. So in general, if we buy a stock and we experience a 10 to 15% loss from our entry price, then I'll normally just exit that stock. With the markets the way they are nowadays, that could happen in a couple days. You could buy a stock and get stopped out of your position literally in just a few days. So by utilizing these volatility strategies, we're trying to avoid being stopped out of our position. And we do that by either selling a call option or buying a put option to help protect our position and avoid being stopped out. And that's been working real well for us. You'll see if you look at the open trade profits for the married put strategy or the covered calls or the option spread, you'll see that that's been working out real well. And those portfolios have substantial profits and a high percentage return and with lots of downside protection. So these volatility strategies are working very well for us. Okay, and today we're going to talk about the married puts in detail. And you create a married put when you purchase stock and a protective put option. And as I said, you normally purchase 100 shares of stock or an ETF for one put option contract. And here's an example of a married put trade I took recently. And I bought 800 shares of the NASDAQ QQQ ETF at 54.35. And then I bought 8 January 55 strike put options at 4.11. So 800 shares of stock and 8 put options. and this created a married put spread. And I did this trade simultaneously. In other words, at the same time I bought the stock, I bought the protective put option. As a matter of fact, I entered this as a spread order in my online brokerage account. This was entered as a debit spread order. Now there's two ways you can initiate the married puts. You can either buy the stock and buy the put option simultaneously, or if you purchase a stock and you have a profit in it, you can purchase the put option at a later date to help protect your profits. So we'll look at both types of married put trades today. And here's the math for this married put trade. And as you saw in my brokerage statement there, I bought the QQQ at 54.35 and bought the January 12 55 put at 4.11. So there was almost about 5 months of until January 12 option expiration when I made this trade. So it's just about a 5-month trade. So the way we calculate the cost is we simply add the cost of the put. In this example was 4.11 to the price that I purchased the QQQ at 54.35. So we come up with a cost for this married put of 58.46. And when I purchased the 55 put option, well, that put option was in force, and like I said, it was almost a 5-month period. The value of the QQQ could not drop below 55 because that's the strike that I purchased on the put option. So when you purchase the 55 strike put option, the value of the QQQ will not go below 55. So if we take our cost of 58.46 and subtract this floor that was created by the put option of 55, we see I have a maximum risk on this trade of 3.46 points. And that's about 5.9% of the cost of the married put. So in this trade, my maximum risk is 3.46 points, or about 5.9%. And to calculate the break-even price, we simply add the cost of the put option, in this case 4.11, to the purchase price of the ETF, and we come up with a break-even price, which is the cost of 58.46, and that's about a 7.5% price move. So the QQQ has to move 7.5% for this trade to break even. And here's a diagram for this particular trade, and this kind of lets you see visually. You see we have a maximum risk of $346, and once the QQQ starts trading above 54.35, our maximum loss starts to be reduced. And then when it trades up to 58.46, then we're at break even on this trade. And I think the QQQ recently was trading around 58.46, so we're close to break even on this trade. And once it goes above 58.46, you can see that's all profit. So each point above 58.46, the break-even point, is 1 point of profit. So with this particular trade, I had a maximum risk of 5.9%, but my return was not limited. So that's one advantage of a married put trade compared to a covered call. With a covered call, your return is limited, but with a married put, your return is not limited, and the profits increase as the stock goes above the break-even price, which is 58.46 in this example. And here's some examples of other married put trades I made. In addition to the NASDAQ ETF, for the emerging markets ETF, the small cap ETF, Apple, and Baidu. So once we establish the married put trade, we have several trade management choices. If the QQQ increases in price, a call option can be sold, which could guarantee a profit on the trade depending on the strike price of the call option. And if you sell a call option against your married put trade, that's normally called a put collar, and that trade acts as a collar. The put, the value of your trade will not go below the strike price of the put, in this case 55, and the profit would be limited to the strike price of the call that you sold. So they call this a collar. So you have the put underneath the trade and the strike of the call option above the trade, and so that's the trade. Your profit remains inside of that collar. Now, another choice that you have, if you have a married put trade, in addition to selling a longer-term call option, you could sell weekly call options against your married put position, and I'll show you an example of that here in a minute. And the weekly call options are generating about a 2% return per week in terms of time value. In other words, if you sell an at-the-money call option, weekly at-the-money call option in the QQQ, it's currently returning about 2% return a week. Of course, when you're short an at-the-money call, if it has 2% time value, that time value goes to zero at option expiration, so that becomes profit. So the time value of any call that you sell becomes profit at option expiration, regardless of which way the underlying stock moves. So, and then the other choice would be just to hold the married put trade until option expiration, and if you do that, then your upside return is not limited. And here's an example of a put collar. Let's just assume that with this married put, at a later date, I was able to sell the 60 strike call option at 7 points. And this is just hypothetical, just so you can see one of these choices is to sell a call option and create a put collar trade. So we have our cost of 58.46 minus 7 points that we received for the call option. So now our cost goes down to 51.46 for the married put. And if the QQQ closes at or above 60 at option expiration, we would we would get called on the QQQ at 60. So if we subtract our cost of 51.46 from 60, we come up with a profit of 8.54 points, which is about a 16.6% return on this. So that's just an example, theoretical example of selling a call option against this particular trade that I have. And then another choice would be to sell weekly options, and this brokerage confirmation shows that I sold 8 of the QQQ weekly. This was September 17th expiration, so this had about a 1 week 1 week to go until expiration. So I sold 8 of the QQQ 53 strike calls at 118, and that was the at the money call option, and the 1.18 translates to about 2.2% of time premium. So over that 1 week period, the time will decay, the time value of that option will decay to 0, and it'll produce a 2.2% return for that 1 week. So if you multiply that 1.18 times 21 weeks, there's a potential there of generating 24.78 points of time value, and that works out to about 46% return. That's assuming that the time value remains about the same over that 21 week period. And of course, with this 46.2% return, we'd have to subtract the cost of the put option from this, and this would reduce our overall return. So that's one choice you have with the married puts, is selling weekly call options. And here's some of my brokerage confirmations where I rolled over the weekly options. And in this example, with the QQQ, I bought to close 8 of the 57 calls at 3 cents, and then I sold to open 8 of the 54 calls at 127. So that's just showing a rollover from the 57 call to the 54 call. And I also, for Apple, I'm trading the weekly options. And in this example, I bought to close the Apple 400 call at 492, and then I sold to open the Apple 405 call at 817. So I entered this actually as a spread order to roll over the options from the September 23rd expiration to the September 30th expiration. So again, this is a 1 week option. So I used a spread order in my brokerage account to buy to close the 400 call and to sell to open the 405 call. I just want to show you that as an example of how you can roll over weekly options. Okay, and another choice you have would be to sell monthly options, and this is an example for American Capital, symbol AGNC. The October 11th call, or the October 11th, October 2011 expiration had about a month to go to expiration. So I'm just showing the call option prices here, and with American Capital trading around 29, if you sold the 29 strike call, which is a monthly call in this case, it generates about a 2% return, monthly return, in terms of time value. So that's also another choice, would be to sell monthly options against a married put. Okay, so let's go over the advantages of the married puts. Your risk is limited, and we saw the example of my QQQ trade, and in that example, my risk was limited to 5.9%. So your risk is strictly limited with the married puts, and of course that's a great strategy for volatile markets, because if your maximum risk is 5.9%, you don't have to worry about being stopped out, and you can just simply hold your married put spread and just wait until option expiration, and hopefully the stock or ETF rises in price and you realize a profit on it. So this is a great strategy for volatile markets because you can simply sit on your position till option expiration. Another advantage is a call option can be sold, which can guarantee a profit depending on the strike price. And we saw the example of if we sold the 60 strike call at 7 points, it would generate a 16% profit. Another choice would be to sell weekly call options against the married put. And of course, the big advantage is it allows you to maintain your position during volatile markets and avoid being stopped out. And if you simply hold the married put until expiration, then your risk is limited, but your upside potential is not limited. And I wanted to talk about one other twist to this married put strategy, and that's creating married puts on stocks that pay dividends, with the idea being when you receive a dividend, it can help pay for the cost of the put option. And here's some samples of married puts I initiated on dividend-paying stocks, and I'll show you examples of 3 of these here in a minute. The first one is for Royal Dutch. I bought the Royal Dutch stock at 60.12 points, and then bought the 60 strike put option for 5.50 points. And the idea is that the dividend I receive from Royal Dutch pays for a big part of the cost of this put option, so that further reduces your risk. And let's take a look at the profit potential on this trade. We can see with the married put calculator, buying the stock at 60.12 and buying the 60 strike put at 5.50, and the quarterly dividend at that time was 0.675. And I put the date that I entered the trade and then the option expiration date. And these prices and dates are coming from they come from this brokerage confirmation I just showed you. So these are actual trades that we're looking at here. So the married put calculator will calculate the profit loss potential for this married put over the assuming various price changes in Royal Dutch Shell stock from in this example, from a minus 50% loss to a 40% increase in the stock price. So in other words, if the stock is traded 60.12, if it declined 50% to 30.06, the max I would lose on this trade would be 1.4%, $90 or 1.4%. Now that's assuming that Royal Dutch continues to pay their quarterly dividend, and this is about a almost a 22-month period from when I initiated this married put to until option expiration. So this is a 22-month trade, so there's plenty of time for the stock to appreciate in value. And again, you can see that the quarterly dividend would pay for a large part of the put option premium. The quarterly dividends, you can see this line here on the calculator shows I'd receive $473, assuming the quarterly dividend stayed the same, and compare that to the cost of the put of $550. So that almost covers the cost of the put. So you have a very low risk trade. And this calculator assumes, as I said, various price changes in Royal Dutch Shell stock. So let's assume the stock was unchanged after that 22 months. At 60.12, I'd still have a maximum risk of 1.4%. And if the stock went up 40% to 84.17 at option expiration, then you'd realize a 35.5% return. So a 40% increase in the stock results in a 35.5% return for the married put. So the married put trade is a little less, but that's the trade-off. You get the downside protection, and you're only giving up, in this example, about 4.5% of that 40% return by initiating a married put. So there is a trade-off, the cost of the put option, but trading with a maximum loss of 1.4% is a great way to go in volatile markets. And it's not, you don't quite match the return for the stock itself if you just own the stock, but in my opinion, it's much better to have this protection in place, even if you have to sacrifice a small part of the yield or a small part of the return. So great strategy for volatile markets. And here's another example from my brokerage confirmation. I bought Bristol Myers stock at $25.49, purchased the 25 strike put at $2.55, and Bristol Myers was paying a 28-cent quarterly dividend. So in this example, our maximum risk was 3.9%, and this is over about a 21 month period. So a maximum risk of 3.9%, or $108. So again, your risk is limited, but your profit potential is not limited. And if Bristol Myers went up 40% to $35.69 over that 21 month period, then this married put would realize a 34.3% return. So another example where the dividend pays for most of the cost of the put option, and in this case, I'd receive a total of $196, which would cover most of the cost of the put option at $2.55. So again, a very, very low risk trade. Here's another example. This is for Duke Energy. Bought that at $28.05 and bought the 27.5 strike put for $2.70. Maximum risk 4.3%. So in general, the married put strategy is the lowest risk strategy that we have in the inner circle portfolio, and that's a great strategy for volatile markets. And I'm showing a snapshot from last week of the open trades in the married put portfolio, and we had open trade profit of $70,716, average return of 41%. And a lot of the stocks in this portfolio are dividend-paying stocks. And as I indicated in the emails that I've been sending out when we initiated these married puts, that I listed what the dividend was in compared to the cost of the put option. And in a lot of cases, it covered a great portion of the cost of the put option. So I usually indicate that in the trade alerts that I send out. And also in the inner circle married put strategy portfolio, we have purchased puts against stock that we had purchased previously, and if we have a profit in that stock, we'll go ahead and purchase a put option to help protect that profit. So a lot of the trades in the married put were initiated after we already had a profit in the stock. And here's an example of one of the stocks that we purchased a put option. This is for Untitled Capital, and I put the with Untitled, our cost basis after accounting for the dividends we've received. The cost basis for Untitled was $8.07, and I initiated a let's see, this is about a 16-month trade. So we have 16 months for Untitled to go up in price, and we purchased the 17.5 strike put option to protect our stock position, and the put option premium was $4.05, and if Untitled continues to pay their 60-cent quarterly dividend, we'll collect $300 in dividends, which covers a big portion of the put premium of $4.05. And you can see in this case, when you purchase a put option on a stock that you already have a profit in, our minimum return for this married put would be 69%, even if the stock declines substantially. Even if it declines by 50%, we'd still have a 69% return. So that's an example of how to protect an existing stock position or ETF position by purchasing a put option. In this example, even if the stock goes down 50%, over the next 16 months, our minimum return would be 69%. If the stock is flat, and we still would realize a 69% return. So this strategy has the ability, not only it's low risk, but it also has the ability to produce great profits if you purchase a put option to protect an existing stock position. Here's another example. This is for enterprise products that we have in the married put portfolio, and with enterprise products, the minimum return, even if the stock, again, even if it declined 50%, we would still realize a 78% return. If the stock is flat, we'd still realize a 78% return. So, again, this is an example of another high return no matter what happens. So, this strategy is ideal for volatile markets. And here's one more example. This is for McDonald's, and our minimum return for McDonald's would be about 43%. So again, very low risk and high profit potential, and the return potential, again, is not limited if you purchase a put option. So to sum it up, this is a great strategy for volatile markets, and that concludes my presentation for today. And in our next webinar, we'll look at the other two volatility strategies, the covered calls and the option spreads. So I just wanted to discuss the married put strategy in detail so that all the members understand how it works. So I'll be glad to take some questions now if anybody has questions about the married put strategy. And let's see. Okay. Okay, here's a question from Padrag, and he's asking, what is the maximum risk percentage you would consider acceptable for a married put trade? And Padrag, I don't really have any fixed number in mind. It just depends on the market conditions and how volatile the stock is. So, but I would say in general, most of the trades that we put on, we have usually about a 5 to 6, 7% maximum risk. And in the examples of the married puts that we did on stock that we already owned, of course, there is no risk on that, and those would have a positive return regardless of the price direction of the stock. But if we do a simultaneous stock purchase and put option purchase, usually the maximum risk is somewhere in the 5 to 7% range, and that again will vary. If we have a more volatile stock, that risk will be higher. So it's going to depend on market conditions and how volatile the particular stock is. Here's a question from Gary. When would a married put trade not be advisable? And I would say if you're looking at a really volatile stock, Gary, and your break even is very high just because of the volatility of the stock, the price of the put option is going to be very high. So if you purchase a put option and you have an at-the-money put option, but you have a 20 to 30% break even, then I probably wouldn't want to take that trade, just because volatile stocks have very high put premiums, and it would take a really big move by the stock just to break even. So in that situation, I probably wouldn't do a married put. Now, if I purchased a volatile stock and I had a profit in it, then at a later date I would consider a married put to help protect that profit, during volatile price swings. Okay, here's a question from Stuart. Would you ever consider closing the put for a profit if the stock dropped and then began trending up? And Stuart, that would require that you time the market. That's pretty hard to do. It's just too difficult to try to juggle that. But normally I would not close out the put, and I would just hold it until expiration. And I may sell a call at a later date if the stock really increases in price, and you want to lock in some of your profit. Then you could sell a call at a later date. Okay, can you use a married put with a 2 to 3 year leap option instead of buying the underlying stock? Would it be riskier? This is another question from Gary, and yes, Gary, that would be a lot riskier, and I normally would not do that, because the risk would just be too great. Because once you purchase an option, a call option, and then you purchase a put option, that's a lot of option premium, and the time value of both of those options is working against you, and you're highly leveraged. So that could result in a large loss. So to answer your question, I normally would not consider using a married put and using a call option instead of the stock itself. Okay, let's see if I have any other questions here.
We do have one question that says, when will the married put stock sheet be available?
The calculator, yeah, the married put calculator is available now. If you email Joe at Inner Circle Support, he can give you access to the married put calculator. Okay, and here's a question from Bob. How often do your at-the-money calls in your covered call strategy result in assignment? And answer your question, Bob, most of the time you won't get assigned as long as there's some time value in the option. But once the time value goes close to zero, then you'll usually get assigned. So I like to be proactive, and if I see that the option has almost no time value left, then I'll go ahead and, if I want to roll it over, I'll buy to close the existing call and then sell to open the call with the new strike price. So, but any time you're short a call, you can be assigned. So that's always a possibility when you're short a call. But normally it doesn't happen if there's time value left in the call option, the short call option. So if you're thinking about rolling it over, then you'd want to buy to close the current short call and sell to open the next one. If you're thinking of rolling it over, if you want to get called, then you would just hold it and the stock would be called. Okay, let's see here if there's any other questions that pertain to the married puts. Okay, I guess that's it. And I want to thank everybody for attending today. And I look forward to our next series of webinars, and we'll go into each strategy into detail, just like we did today with the married puts. So we'll look in upcoming webinars. We're going to look at the covered call and option spread strategies in detail. So I want to thank everybody for attending, and this is Chuck Hughes. Over and out, and I wish you the best in investing success.